Whether the crypto markets are bullish or bearish, you can still profit with different DeFi strategies. In today's video, I'm going to give you guys a couple of DeFi strategies you guys can use to arbitrage yields and profit. These range from 10% to over 450% APR. I'll also go over one later in this video that's a little more risky, but for the past 3 epochs, it has actually been paying out 220 to 480% ROI. Not APR, ROI, return on investment. So if you invested $100, it would now be $400 or $200 if it had a 200% ROI. Stablecoin arbitrage. This is where we're going to start. By the way, guys, timestamps will be in the description below. If you already understand this part and want to get started with the strategies, just go by the timestamps. It'll allow you to skip to the different strategies. So, arbitrage is the simultaneous buying and selling of securities, currency, commodities, and different markets or in derivative forms. This is to take advantage of the different prices of the same asset. Let me give you an example of what arbitrage would mean. If I see a candy bar in a store selling at $1 and I see other guys buying candy bars for $2 from another store, the arbitrage is buying it from the store for $1 and selling it to the other guys for $2. I profit the difference, which is $1. That's how you arbitrage. Yeah, I get it. It's a bear market right now. A lot of people don't want to mess around and play with different strategies. But remember, bull markets, sure, you can make some money. But bear markets, you can actually make life-changing money. This is a great time to learn this junk and prepare, especially while gas fees are low and you aren't getting wrecked on gas fees. So you can still profit when the market is going up or going down. You just need to play your cards correctly. So here are some strategies. This is the beginner strategy. If you guys are already in DeFi for a bit of time, this is pretty self-explanatory. It's just depositing into vaults. But if you're new to DeFi, think of it like depositing into a bank account and earning a yield. This is a screenshot of some yields on Aave. You got DAI paying around 2% because you have the 1.31 and then you have 0.98 in the Avalanche token. Then same thing with USDC, and then Tether is paying around 4%. So if you're just wanting to deposit in vaults and doing something simple and self-explanatory, you can do that. Aave is okay. However, if you're trying to keep it simple, look for leveraged yield farming protocols. The reason for this is degens are willing to pay a higher yield because they're borrowing more collateral to leverage. You can also use Kava, but your rewards are locked. This one's a little bit simpler. You just deposit into the vault and you can earn 25%, but these rewards are locked over a year period and they're paid in the Kava token. So if you don't want to be paid in a goofy token, look at the leverage yield farming protocols. You can get almost 16% on your DAI on Alpha Finance, 12% on USDC, and you can also see over here on Iron Bank, you can get around 12% USDC and 16% on DAI. This is a screenshot on Impermax. This is paying 11%, and it's even paying 50% in ETH. And Permamax is also a leverage yield farming protocol. Leverage yield farming protocols allow the user to seek after a higher yield. I'll explain what that means in the next slide. Users are willing to pay a higher yield to borrow those tokens because they're earning a higher yield. So they're paying you 10%, but they're earning 20%. So they're arbitraging the spread, giving you 10, pocketing the other 10. That's how it rolls. So here are the risks with depositing into leverage yield farming protocols. You have smart contract risk, you have hacks, you have bad debt risk, and you need to wait to withdraw if it's fully borrowed. Here's an example of what a leverage yield farming protocol would look like. You're earning 18% on your ETH or 5% on your stablecoin, and you're like, cool, this is sauce, I like this. The other guy is earning 67% at 5x leverage. This is why he's willing to borrow. So what these leverage yield farming protocols do is allow the user, when they deposit their LP tokens, to borrow against them. So they're able to borrow collateral like ETH and USDC, redeposit them into their LP pair, and then borrow more. What this does is instead of having $1,000 earning 10%, they can actually have like $5,000 or $6,000 after paying fees earning around 5%. Which is more, earning $1,000 at 10% yield or $5,000 at 5% yield? Well, it's actually the $5,000 one. So you're basically earning $250 a year instead of $100. So that's how you can look at it. But there are risks involved with this because the utilization, if this is over 100%, you can't withdraw your tokens. Now, of course, over time, as people repay their loans or withdraw their collateral, I mean, you can withdraw. But if you're tight on funds and you're deposited into a vault with a very small amount, let's say, for example, this is $10,000 and you hold like 80% of the pot, well, good luck withdrawing that, especially if it's over borrowed. So on average, you can get 1 to 15% on yields, sometimes more, depending on these leverage yield farming protocols and depending on the tokens. We're going with the more stable-ish assets like ETH, USDC, Bitcoin. Now, I've seen these as high as like 100, 150%. And you can see in one of the previous slides, it was literally paying 50% APR in ETH. So it's not out of the ordinary to see that. It just doesn't usually last long because people deposit. So expect about 1 to 15%. Now, this is the moderate strategy. This is involving GLP or SNX. For GLP, you want to lend stables out on like Aave, Compound, etc., and then borrow based on the pool weights. So as you can see here, this is a screenshot of the GLP pool weights. If you don't know what the GLP token is it's basically a token that represents a basket of different assets. So GLP is composed of 28% ETH, 25% Bitcoin, and you can see the other percentages. But on average, based on the pools, the target is about 45% in stables, 53% in Bitcoin and ETH, and 2% in DeFi tokens. To hedge this strategy, we're just going to focus on the big ones, which is 45% stable, 28% Bitcoin, and 25% ETH. Sure, there will be like a 2% fluctuation, but it shouldn't be super crazy. Let's go and get into the strategy. This is the GLP section. I'll explain the SNX one. I like the SNX one better because it's easier to manage, but let's do the GLP. So let's say I want to invest 20K. What I would need to do is deposit $13,000 in stables to GLP. I would earn 20+% in GLP/ETH. This is just what the yields are paying on GMX. Sometimes it's paying you 40%, 60%, 20%, 30%. It varies, but at least you're typically going to get about 20%. This is on Arbitrum network, so keep that in mind. The other 7K, I want to go ahead and deposit this on Aave. I'm going to borrow ETH and Bitcoin based on my position in GLP. What's going on right now is I deposited 13K into GLP. So it already split up my deposit into stablecoins, some Chainlink, some Uni token, some Bitcoin, and ETH. When I deposit, it automatically does that for me. This 7K I have left on Aave, I'm using this to hedge my position. I'm going to borrow some Ethereum and Bitcoin based on my position in GLP. So an example of this is if I have $13,000 in that GLP pair, 25% of that 13K would be $3,250. 25% is going to represent ETH. Remember, the pool weight of ETH, as you can see right here, is 25%. I need to hedge my position. I'm borrowing it because I'm going to short it. I'll show you guys later. 25% of 13K in ETH would be $3,250. So I need to borrow $3,250 worth of ETH and go ahead and market sell this for stables and then lend this back on Aave to increase collateral ratio as well as earn a yield. So effectively what I've done is I've taken my ETH, which is now my debt, and I've sold it for stablecoins. These stablecoins are now being lent back to Aave. I would need to do this same exact thing for Bitcoin now. Since Bitcoin is weighed at 28%, I would do the 13K multiplied by the 28%, and I would get a little less than $3,500. I would repeat the process. I would borrow some Bitcoin, and now I would sell it for stables and deposit into Aave. I've effectively shorted the position because now my debt is denominated in Bitcoin and ETH. So I'm short Bitcoin and ETH on Aave, and I'm long Bitcoin and ETH on GMX because I have the GLP token. It means I'm holding those assets. When you hold assets, you're bullish. When you short assets or sell them, you're bearish. So I'm basically earning a 20+% minus the borrow fees. The reason why it's delta neutral is because I'm short and I'm long at the same time, but I'm in GLP, so I'm arbitraging the yields. Yes, you say it, arbitrage. All right, so let me show you a little bit about what I meant when you borrow a token. That's what your debt is denominated in. This is on Aave. This is a position that is open. 6.5 ETH is being lent out. This is my collateral. This is the asset that I'm bullish on. This is the one that I own. I'm getting a loan against it in USDC. When you get a loan against it in USDC, that means your debt is USDC. I need to go back and buy and repay this. So in theory, if I wanted to short something like Link or Bitcoin or ETH, what I would do is borrow it. So I'm borrowing ETH. Let's say I borrow 1 ETH. The ETH price is around 1580, 1590. So that means if I borrow the ETH and sell it for stable coins immediately, I have effectively shorted ETH. So at any given time, I need to go back and buy my 1 ETH to repay my loan. When I go to repay this loan, if ETH is trading at $2,000, that means I lost money on my short. But if it's trading at $1,000, remember I sold it at 1580. I can buy it back for $1,000. I buy 1 ETH, $1,000, and I profit the 580. That's what I mean by your debt on Aave. So you're effectively shorting it. Let's show you what it looks like on GMX. If I wanted to go ahead and buy some GLP, all I would do is say, hey, I want to deposit 1 ETH and get some GLP. There are some fees involved because remember there is some slippage between swapping this. So if you want the lowest slippage, look for the token that it has the least balance in it, that is trying to rebalance and get to the desired range it wants. So if it wants 25% ETH and there's 28% in the vault, well, there's going to be some fees for that because there's way too much ETH. However, the opposite is true. If the target is 25 and there's only 20 in the vault, they're going to give you a premium. They want more ETH. So it's just going to be the slippage and whatnot. But when you're depositing into this and getting these GLP tokens, factor in and keep in mind, if the traders are winning, you're losing money. But if the traders are losing, you're making money. This is how the GLP token works. They're basically trading against you. So you can mirror this debt pool by managing and following the ratios of the GLP collateral token and opening positions on Aave by borrowing some Bitcoin, ETH, and of course the stables are deposited in there so you don't have to worry about that. But you hedge your position. If you don't understand where we're at so far, just rewind the video, listen to it a couple times. It will sink in your brain and you will understand what I'm talking about. Don't worry, I'll give you another example so we'll recap so you guys can understand it. This is the synthetics option. This is the same exact concept, but it's a much easier method to do because you don't have to go on Aave, borrow a bunch of transactions, yada, yada, yada. But the SNX option, the strategy to get delta neutral on this is lend out some stable coins on Aave and borrow SNX from this. As you can see, the cost to borrow is going to be around 21%. So I'm paying 21% right now to borrow. However, when you stake your SNX token on synthetics on Optimism Layer 2, you can earn 54%. Sometimes it pays as high as 250, 300%. It just depends how volatile the market and how many trading fees are going through. So this percentage usually ranges from 50 to 350%. No lie, no joke. I'm being legitimate when I say this. It pays nuts and ham. When you stake your SNX, you need to understand you're actually taking on debt because you borrow some SUSD. This SUSD you borrow though, you can actually throw this back on Aave and boost up your liquidation ratio so you aren't getting liquidated. But just keep in mind, you do have to manage your collateral ratio. I've made a couple videos on synthetics. If you don't understand how that works, you can understand it a little bit better. But the TLDR on what I'm doing is I'm borrowing on Aave for 21%. I'm theoretically short SNX because that's what my debt is in because I'm lending out stables. And I'm staking it on SNX. I haven't physically bought SNX token. I'm just borrowing it. My debt is in SNX. So if it goes up to $10, my debt goes up to $10, but I still hold it, so I don't care. But if it goes to $0, I still hold it. I don't care. I never bought it. It's just whatever. I'm siphoning the yields. I'm taking the arbitrage. I'm earning 50 to 350% on SNX, and I just have to pay my measly 21%. Of course, this varies. Sometimes it goes up to 100%, but if I'm making 350 and my debt is 100, it's just the cost of doing business. Whatever, I don't care. Now, if you want to manage your debt instead of depositing the SUSD on Aave, because you got to understand you're taking on a debt position. As people are trading and they're profitable, they're actually going to be making money on you. It's the same thing with GLP and GMX. So you need to hedge your position. That's why we hedged on GMX. We're going to go ahead and hedge on synthetics. We're going to use DSNX for this. This mirrors the debt pool. As you guys can see here, it's been mirroring the debt pool over time. And what this means is your debt isn't going to move. So your debt actually can go up and it can go down. So if you have a lot of debt when the market is super high, that's actually a good thing because that debt will come down as the market comes down. So if you staked your SNX when ETH was at 4,000 and Bitcoin was at 69K, you're golden right now. It's basically way less and your debt was reduced. So it's like sauce. But if you're taking on the DSNX, this mirrors the debt like I showed you. And this will allow you to get a delta neutral position because you turn your SUSD to DSNX. Again, let me recap. You're paying 21% on Aave and you're staking your SNX to earn 50 to 350% yield. You're siphoning the difference. Your debt doesn't move because you bought DSNX. It hedges and mirrors your debt pool. So you're okay. That's the second strategy. Now, what are the risks involved with this? First, you have liquidation risk. If you get liquidated, you lose your money. So that has to do with volatility. This can be on Aave and on synthetics. You can get liquidated there too. And when other people are liquidated and you're staking, you actually get liquidation rewards. So as long as you're managing your debt and being a good credit card holder, whatever you want to call it, you'll be okay. Not properly hedging. If you don't hedge your position, and if you're holding a lot of Bitcoin and ETH and they nuke, well, your portfolio is going to nuke. But if they skyrocket and you didn't hedge, I mean, dude, good for you. You also have DPEG risk. So this has to do with the SUSD or USDC or any of the other stable coins you're holding. Just something to keep in mind. If SUSD depegs, I mean, theoretically your debt goes to zero because, again, you're borrowing that. But SNX probably won't do well as well if that happens. Now, this video is getting kind of long, so I'll give you guys the advanced strategies as well as the expert strategies in another video. So let's go ahead and give you guys a wisdom one-liner, and we'll give you guys the other strategies later. A wife of noble character is her husband's crown, but a disgraceful wife is like decay in his bones. Oh snap. Anyways, some closing thoughts for the channel. What did you think of the video? If you enjoyed it, give a like. Tell me what you thought. Leave it in the comments below. I mean, any feedback is great. Let me know. Obviously, the previous videos, seems like people are unsubbing. I guess I'm doing doo-doo, but hey, it is what it is. I'll keep doing the best I can to reshape the channel and allow you guys to get value. That's the whole reason for the channel, is to bring value to you guys. And like I said, if it's awful, just tell me why. Put a dislike and be like, bro, this is horrible. Never do this again. And if you want to hear more, say, cool story, bro. And if you just want more strategies like this, you can also join the DigiSquad Discord. I like to give out different strategies and tell you what I'm doing in the market, so you can join that as well. And shill of the day, try GMX, get 5% off trading. Just type in capital DD for your referral, whatever. Anyways, guys, thanks for tuning in. We'll see you guys in the next one.